Hey everyone, let's talk about something that's quietly stressing out an entire generation. Buying a house, not a mansion, not a luxury penthouse, just a normal home. Because across the world, something doesn't add up. People with stable jobs, decent salaries, good credit, are struggling to buy property in their own cities. Meanwhile, their parents bought homes in their 20s or early 30s. So, what changed? In many major cities today, the average home costs 8 to 10 times the average annual income. In some places, even more. That means even saving for the down payment can take years. And then, there's the mortgage. A few years ago, interest rates were extremely low. Today, they're much higher. So now, buyers are facing high prices and high borrowing costs at the same time. That combination didn't used to be normal. And it's not just one country. This pattern is showing up across North America, Europe, Australia, and parts of Asia. So this isn't random, it's structural. In this video, we're going to break down exactly what changed and why housing feels so much harder to afford than it used to. Because once you understand the mechanics behind it, the situation starts to make a lot more sense. Make sure you watch till the end, because I'll show you practical ways to avoid getting trapped in this cycle. Let's step away from emotion and look at what the data shows. For decades, in most developed economies, the average home cost about 3 to 4 times the average annual household income. That ratio stayed relatively stable. Incomes grew, home prices grew. Not perfectly, but roughly together. But today, that relationship is broken. In many major cities, the price-to-income ratio now sits between 8 and 12. In some areas, even higher. That means a household earning $80,000 a year might be looking at homes priced at $800,000 or more. Historically, that is abnormal. But price alone doesn't tell the full story. Affordability is determined by monthly payments, and monthly payments are driven by two things: the price of the house and the cost of borrowing money. After the 2008 financial crisis, central banks lowered interest rates to stimulate growth. For over a decade, money was cheap, very cheap. Mortgages at 3%, sometimes even lower. That dramatically increased buying power. See? When borrowing becomes cheaper, buyers can afford larger loans. And when buyers can afford larger loans, sellers raise prices. From 2010 to 2020, home prices steadily climbed. Then came 2020. Governments injected massive stimulus. Interest rates dropped again. Demand surged. Remote work allowed people to move. Savings increased, and housing demand exploded. Prices accelerated faster than at almost any time in recent history, but then inflation arrived, and interest rates began rising rapidly. Now, here's where the squeeze happens. A home that cost $500,000 at a 3% mortgage might have felt manageable. At 7%, that monthly payment jumps dramatically. Not slightly, dramatically. Even if the price of the house doesn't rise further, the cost of owning it does. So today, buyers face both elevated prices and elevated interest rates. That combination is historically rare. Normally, when rates rise sharply, prices cool down, but supply shortages have kept prices high. Affordability has deteriorated faster than most people expected. This is why it feels harder now, because mathematically, it is. The gap between income and housing costs has widened, and when that gap stays open for long enough, it stops feeling like a cycle. It starts feeling structural. So the real question becomes, what structurally changed? Why did housing stop behaving like a basic necessity and start behaving like a high-performance financial asset? To answer that, we need to go deeper than interest rates. We need to look at supply, incentives, and who is actually buying. So what actually changed? Why does housing feel harder now than it did 20 years ago? It comes down to three big shifts, and once you see them, you can't unsee them. First, we didn't build enough homes. That's it. More people moved to cities. More young professionals delayed marriage, meaning more households were created. Population grew, demand grew, but construction didn't keep up. In many cities, building new housing became slow, expensive, and politically complicated. So you had more people competing for fewer homes. And when that happens, prices rise, not because houses became luxurious, but because there weren't enough of them. Second shift, money became extremely cheap. After the 2008 crisis, central banks slashed interest rates. Borrowing money became easy. When loans are cheap, people can afford bigger mortgages. When people can afford bigger mortgages, sellers raise prices. It's not evil, it's math. Then during 2020, governments injected massive stimulus into the economy. Savings went up. Rates went even lower. Remote work allowed people to move anywhere. Housing demand exploded almost overnight. Prices didn't just rise, they accelerated. Third shift. Homes stopped being just shelter. They became investments. When interest rates are low and prices keep rising, real estate looks safe. So investors entered. Individuals bought second properties. Companies bought entire buildings. Large funds started treating neighborhoods like portfolios. Now, first-time buyers weren't just competing with families. They were competing with capital. And capital doesn't buy emotionally. It buys based on returns. So what do you get when you combine not enough supply, cheap money, and investor demand? You get fast price growth. And once prices rise far enough, they detach from local incomes. That's when affordability breaks. And when interest rates later rise, prices don't automatically crash because supply is still tight. Owners with low mortgage rates don't want to sell. Inventory stays limited, so the pressure remains. This isn't random, it's layers. Each shift stacked on top of the previous one. And slowly, quietly, housing stopped behaving like it used to. So here's the uncomfortable truth. This system rewarded people who already owned property. If you bought years ago, locked in a low rate, your net worth probably grew while you slept. If you're buying today, you're paying higher prices and higher interest. That's not your fault, but it is your responsibility. Because the worst thing you can do right now is play the game emotionally. You need a strategy, not hope, not pressure from family. First, stop chasing the dream house. Your first property is not your legacy. It's your entry point. Too many people skip the starter phase. They want the perfect location, perfect layout, perfect everything. Meanwhile, prices move, equity compounds, opportunities pass. What if instead you bought something smaller, older, slightly outside the prime zone? Not glamorous, but financially smart, because the goal isn't to impress anyone. The goal is to own an asset that grows with time. That's how people quietly build wealth, not fear of missing out. A strategy. And realistically, second, if the payment feels heavy, make the property work for you. Why does it have to be purely an expense? Could you rent a room for 2 years? Buy a place with a rentable unit? Choose a property in an area with strong rental demand? If someone else covers even a third of your mortgage, your stress drops, your risk drops, and your timeline accelerates. Most first-time buyers think like consumers. Wealthy buyers think like operators. That's a big difference. And this one requires discipline. You might not buy right now, and that's okay. In some cities, prices are stretched. In some markets, rent is dramatically cheaper than ownership. If you rent strategically and invest the difference, you can build a stronger down payment, increase your income, improve your credit, enter the market later, but from a position of power. Ownership is powerful, but forced ownership is dangerous.